Now, traders at UBA say Nigeria's bonds market is experiencing some reversals and drop in prices as the market anticipates the fourth quarter bonds auction calendar. As we await the outcome of today's Treasury bills auction, Bankole Odusanya is the head of fixed income trading at UBA. Joins me now as we look at how the fixed income and FX market is for investors today. Thank you so much for your time on the show, Bankole, and let's get started off with that Treasury bills auction and what can we expect?
We are expecting another marginal decline in stock rate. We have seen movement from 3.05 to 2.8% discount rate at 2 weeks ago. The yield was held at 3% for a long while, but we've broken the support level and it stopped at 2.8% the last time, and we expect that this time around it could go to a 2.6% levels. The reason is simply because there's limitation of or restrictions of participation of most of the local corporates in OMO markets. So therefore, the issuance of securities is reduced compared to demand. If you see maturities coming in this week, 460 billion from Treasury bills, 500 and about 90 billion last week. That's over $1 trillion. But what's available in issuance by way of OMO bills and DMO NT bills is just about 105 billion and 100 billion respectively. So that's just about 20% of the funds coming into the system. So these funds are driving the demand on the entire fixed income space. We have also seen that there's been some diversion of funds from the fixed income space to more attractive sectors like the equity market, where yields seems to be better for now.
All right, talking about attractiveness, though, let's get to the bonds and how attractive we see that space, and I'd like to get your thoughts on the Q4 bond calendar when it comes in.
Yeah, right now, the demand pressure that I described right now has dragged yields on the bond curve, especially the short end 2022, all through to 2025 to between 3 and 5%. So as we speak, 2045, 2035, which are still being open at the auction, are at 8.15 and 8.5% levels. This seems attractive to the PFAs and other local corporates who are investing on the long run. The challenge, however, is that we're also seeing profit taking since yields have dipped for so long. Since the beginning of H2, we've seen yields continue to slide down, and there's room for profit taking. So we are seeing that. And there's some caution, on the other hand, that the DMO could issue more of these reopening bonds to be reopened this month. We haven't seen the calendar for the Q4, and that is putting some traders and position holders on inquiry that, yields could reverse. There could be some form of reverse if the DMO were to increase the instruments on offer. Of course, the thoughts behind that have to do with the budget being presented for next year and the desire for growth in spending, where expenditure gap deficit is about 4 trillion, and we've seen that revenue, the ability to make revenue is not increasing or getting better with few opportunities to raise funds via credit. We've heard the Vice President say that it's not likely they go into the Eurobonds market, so bilateral fundings and borrowings are likely to be the way. If there were to be delays or further decline in revenues from crude oil, there will be a huge gap to be met. And looking at the mood of the country, especially with the unrest, we expect that the government will be willing to spend a lot out of most of the challenges they have. So it's possible that they could ramp up issuance of debt on the local currency side more than what we are seeing presently. On the average, we are seeing 100 to 150 billion being offered. It could simply go to 200 billion or more. And when that happens, the tendency to be that there will be a reversal of yields and prices. So there's some caution right now in trading on bonds, and there's also profit taking. And that's why we are seeing some sell pressure and a little bit of epic demand on the bond side.
All right, but let's get into the money market, and we're seeing that inflation is expected to come out tomorrow. But I'd like to get your take on how it has been, because I understand the money market has been quite tight lately.
Well, yes, it's been tight because of the CRR being used as an instrument of the central bank to manage system liquidity. Of course, in view of inflation targeting and FX management also. The system liquidity is around 220 billion. Of course, tomorrow, Thursday, we expect over 400 billion to come in. But by Friday, most likely, there will be CRR debits just to ensure that there's not so much funds dragging or pursuing, pushing after the FX and causing some additional pressure. So basically, it's just the CBN managing liquidity as we speak. But when these funds come in also, there's likely to be some added demand on the short end of the bonds. It's supposed to continue, despite the caution I just explained earlier.